Welcome, everyone. Please note that this session will be recorded for informational, educational, and marketing purposes. Our event will begin shortly. Hey, so good evening from Singapore and good morning or afternoon if you are joining us from other sides of the world. On behalf of Nanyang Business School NBS, United Nations Supported Principles for Responsible Investment, PRI, and European Corporate Governance Institute, ECGI, a very warm welcome to our very first lecture this year of the NBS-PRI-ECGI Public Lecture Series on Sustainable Business. My name is Yuxia Zou. I'm assistant professor here at NBS and your host for this session, representing our dedicated lecture organizing committee. So our lecture series is a global initiative started last year, aiming to facilitate knowledge exchanges among academics, practitioners, and policymakers in the field of sustainable business. So in this year in total, we have 8 lectures. Each lecture features a 60-minute talk by a leading scholar in a specific field and a 30-minute Q&A moderated by an industry expert on this topic to help connect academic insights with practical experience. After each lecture, the event recordings and summaries will be shared online to build a public library on sustainable business for everybody. If you missed earlier talks, please check out our recordings on YouTube and also summaries via the ECGI blogs. The recent snapshots are shown on the slide now. So today, we turn our focus to a very critical pillar of sustainable investment that many of us are interested in, which is the carbon transition risk. It's my great pleasure to introduce our speaker, Professor Marcin Kacperczyk, Professor of Finance at Imperial College London. So Professor Marcin is a world-renowned scholar on sustainable investment and institutional investors. His pioneering work has fundamentally shaped how we understand information is processed by the markets, and more recently, how climate risk is priced into the global market. So his research has not only been published in the world's very leading finance and economics journals, but also creates a significant impact in the real world, receiving frequent media coverage and prestigious awards, such as the PRI Academic Network Conference Best Paper Award, Moscow With Prize Honorable Mention, and the JFE Hall of Fame. Beyond his research, he's a leading voice in the global finance community because he has served as the president of the European Finance Association, EFA, and currently he is the managing editor for Review of Finance, one of the top journals in finance. He's also a research member of ECGI and a research associate at the Center for Economic Policy Research. So today we're incredibly fortunate to have him here with us to share his latest insights of his research and the field. We have a 30-minute Q&A after the lecture. So during the lecture, please feel free to ask your questions using the Zoom Q&A function. And our moderator, Sara, will help address as many questions as possible later. So now, Professor Marcin, the floor is yours.
Thank you so much, Yuxia, for this very kind introduction and for giving me the opportunity to summarize the views that I have on, I think, this very important topic of transition risk. So the lecture today will be more of a summary of what I've learned and what I think are the key challenges in this particular context. So it's not a specific paper I will be referring to, but at times when certain ideas may pop up, I may refer you to a particular research that I have done. So obvious to this audience, of course, is the idea that climate is a concern. The climate change that is potentially happening at our feet is actually something that should not be taken too lightly. Scientists have been doing a lot of service to help us understand this topic a lot. And here is the kind of very short summary of how I see the scientific evidence and how this is going to actually inform my lecture today. So on the left picture, you see the evolution of global temperatures over the last couple of centuries. And Clearly, what scientists have been observing in the data is that at least for the last 5 decades or so, there has been a change in the slope with which the global temperatures have been going up. So this has been measured at different locations, and at this point, I think there is a pretty strong evidence that there is clearly something going on with the temperatures. And the question that is probably more interesting for many people is what causes it and what to do about it. So the right picture is kind of one graph that comes from IPCC that is a good kind of indicator that maybe the humans have something to do with it, where we are trying to superimpose the amount of global emissions that are produced in the world over time. This is the green line. And the black picture is essentially telling us about the temperatures. And what you see is that the two lines or the two curves that you see in this picture are very highly integrated with each other, which suggests that whatever we actually observe in terms of the changes in the temperature could be potentially attributed to these emissions. And of course, in economics or finance, we always are cautioned about correlation versus causation. So this picture clearly looks like a correlation, but this is where science helps us. There is a lot of scientific evidence that is more experimental and actually firmly confirmed that actually says that this is not just a correlation, but it is something that has actually a causal field. So why is that necessary? Well, if we as a society think that we are actually enduring potentially an existential problem because our livelihood is going to be threatened by the increasing temperatures, we need to think about what it is that we should be doing to actually at least mitigate this problem. And of course, from that graph I showed you, the immediate solution that comes at hand is the idea that we should be reducing our emissions. So that leads to this idea of decarbonization that many policymakers, academics, and practitioners have been talking about. Importantly here is to recognize two things. We are living in the world in which currently we are emitting roughly 40 gigatons of CO2 per year. And we need to actually go to the world where actually that number would be closer to zero. Of course, everyone recognizes that this is not going to happen overnight. This is a potentially costly process. That's why some of the, at least implementation or indications from policy and scientists is we should try at least to do it in the next couple of decades. The idea of a net zero objective is something that is oftentimes associated with this problem of decarbonization. Of course, the objective is clear. The question is more how to achieve that. And this is where economists have been actually quite influential in the way how they try to shape this policy debate and the practical implementation. And the key kind of idea that has been coined quite a few decades ago by Nordhaus and Weitzman and others is this idea of carbon pricing or carbon tax. So this is a very simple idea which says that we should be actually taxing emission activity. And if we do it at the global scale, we should actually achieve what we call the first best solution. And ultimately, companies should respond and actually decarbonize. So this seems very nice and elegant in theory, but it turns out that this is more of a planner wish rather than something that we have observed actually being achieved. So what we observe is that this idea of carbon pricing is actually still quite unevenly applied. Roughly, we are talking about 25% of emissions right now, which are covered by carbon pricing. And more so, even that tax that is being imposed is uneven. There are certain locations where actually this tax is so small that it would not be large enough to actually incentivize the polluting sector to decarbonize. And there are other issues, of course, that are mentioned, given that not everyone is actually following this rule. There is a concern of free riding, carbon leakage, etc. So Carney in 2015 summarized it very nicely by saying that there is some kind of regulatory inertia that is costly because these physical processes that we observe in the atmosphere are actually time sensitive. So that brings me to the concept that I wanted to talk about today, which is this idea of what else actually determines how we should be thinking about this decarbonization and the solution. And the idea that I want to introduce and summarize in this talk is the idea that financial markets care about this process of decarbonization because it generates risk. It generates risk that we call transition risk. And as any financial institution and people who participate in financial markets, we should actually care about risk because this is actually a risk management kind of practice. So what I want to start at the outset is this idea that these are somewhat the two parallel worlds. There is a world of planner who wants to actually implement the carbon tax, but there is also a world of someone who lives in financial markets where economic stakes are basically subject to different shocks and risks, and that someone has to actually think of how to manage that specific risk. So question is, where is that risk coming from? And it turns out that there are potentially different sources which inform this particular risk. So on the one hand, you can think that there are issues related directly to the kind of a technical process that drives actually emissions. So if we talk about decarbonization, oftentimes we talk in parallel about technological progress. The idea of renewables, how we should potentially shift from the fossil fuel energy to renewable energy are clearly the ideas related to decarbonization. At the same time, there are two ways in which this can happen. One is the kind of free market approach in which everyone is going to embark on this technology and try to do their best utilizing it. On the other hand, there is also policy that may actually put some forces on how fast this process should go. And both of these functions, technological progress and policy tightness, of course, they are subjected to a lot of uncertainty. So these elements in general generate this force of transition risk. In addition, an additional force that actually matters for this transition risk is how the beliefs of the society evolve. There is a strong economic reason to believe that people's beliefs about how strongly climate should be addressed are also an additional force in the price of this transition risk. The simple paradigm is the more people care actually about these particular forces, the higher should be an amplification of this kind of forces on the transition risk. So given these sources, it is important to actually think, how big is this source? How big is this risk? And how should we actually measure this? So this is a big part of my talk that I would like to devote time to right now. So the first thing I want to make it clear, and this is kind of my understanding of the market, is that at the moment we have quite a large number of different metrics of transition risk. And it's actually interesting to observe that oftentimes these metrics are used in an unconditional way without qualifying why they actually matter and what use they actually serve. So in this table, I kind of try to summarize a little bit where I see some of these metrics fit in the landscape of transition risk measurement. So just to mention a few ideas, the level of carbon emissions has been one of the ways in which carbon transition risk has been proposed as a measure. And you could argue that that could be, for example, relevant for someone like impact investors. Impact investors care a lot about how much actually economy contributes to the total global budget. So in this regard, if they think about managing that risk and designing some kind of action based on that specific aspect, clearly looking at carbon footprint in total would be very useful. Of course, there is a limitation that we recognize, which is carbon footprint by itself is size dependent. So in this regard, we get this kind of joint hypothesis problem, which is how much is it size, how much is it really emissions that has to be sorted out. Separately, there is the story of intensity, which is essentially a scaled measure of emissions that tries to take the total emissions and scale by some kind of value of firm or maybe production costs. And that's what we call efficiency measure as well. And oftentimes this measure is applied by regulators. It also shows up in the EU taxonomy in other places. What's interesting about that is that that by itself, even though it's so popular, is not actually free of problems as well. So some of the ideas that I will try to introduce you to today will actually try to tell you a little bit more how we should think about potential limitations of this particular measure. And I could go down the list. In the interest of time, I'm not going to do, but again, to summarize, what I hope is coming visible from this table is the idea that despite all these many measures that we have, it's really not prudent to think of them as perfect substitutes, largely because they capture different aspects of the whole framework of climate risk, and they are not necessarily always used for the same kind of purpose as we would think, broadly speaking, when we think about transition risk as an abstract issue. So then maybe to substantiate this claim, why there is a potential trap that we may fall into if we actually think of these measures as substitutes, I have produced this very simple heat map that illustrates the correlation between the different measures that are popular in this literature as the kind of measures of climate risk. And again, without going to details, what I want you to get out of this particular picture is essentially the simple idea that the joint correlations, the pairwise correlations across different measures are actually far from perfect. We are talking about measures that oftentimes are even opposite of the correlation structure between each other, even though at the principle, they are actually supposed to measure the same thing, some kind of degree of greenness or maybe exposure to climate risk. So given that we have this kind of conflicting signals, the natural question, and I think a very important question that has to be answered, is which one of them actually captures financial risk? If you are a financial manager or risk manager of a big institution, which of these metrics should you be taking actually as a guidance for your portfolio or for actually thinking about hedging this particular risk? So I will try to give you a little bit of ideas of how I think about this particular answer. So this is the kind of skeleton or the roadmap that I have generated for these remarks. So first, I will try to talk a little bit about the measurement issues. What are the potential pitfalls that we may fall into when we actually zoom in on single metrics? Then I will try to clear up a couple of what I call common misconceptions in the way how I see people think about some of these applications. And finally, a little bit more prescriptive, I would like to offer a little bit of my own view of what I think practitioners and maybe actually policymakers should also think about when they think about practical address of this particular risk. So let me start with the first point, which is this idea of measurement. And I want to illustrate some of my ideas with 3 case studies. So the first case study I want to start with is that story of emission intensity. So I've already mentioned that emission intensity is actually very popular in the climate circles. It's present in regulatory guidance. There are a lot of actually screens that are actually associated with intensity, to the point that people actually tend to believe that this is all that matters, that we should be actually focusing on this idea of how efficiently we can decarbonize our operation. And if we do it in the right way, we should actually be making some progress. So the question that I would like to pose here is, to what extent is intensity alone a sufficient statistic to capture actually financial risk, the transition risk? And so why is this important? Why does it matter? I think there are at least a few reasons you could give. Here are the 3 I've listed. So portfolio screens oftentimes use intensity thresholds. If you look at the portfolio of asset managers, the large institutions, oftentimes you see that they actually respond in terms of their positioning with respect to the emission intensity. Discount rates oftentimes are implied and calculated using intensity metrics. This is what we tend to call carbon transition sometimes, by just essentially obtaining some kind of price of risk out of intensity. And then policymakers conduct stress tests that are actually oftentimes based on intensity. So clearly, the threat that we are facing here is that if this intensity metric is insufficient, we may be actually misrepresenting the risk that we are actually facing when solving all of these problems I have just mentioned. So what are the positives that draw people to this particular metric? Clearly, it seems too intuitive to think of the following example. If I have 2 firms, each of them emits each of them generates $1 million of revenue, but one of them does it with 100 tons of emissions and the other one does it with tons of emissions, the latter seems actually more appealing than the former, at least if you care about this particular climate consideration. And the policy, of course, recognizes that and thinks that this is the natural metric to actually follow. And as I said, this is actually present in many different policy frameworks that we see. And there is actually an economic statement that you could formally show that under the planner's problem, emission intensity actually is the sufficient statistic that actually matters. The problem here is that the planner's problem is not a financial risk problem. These two need not necessarily be the same object. And there is a gap that I want to argue between the two. And that gap may actually drive our inference about how actually practically we can use intensity as a sufficient statistic for carbon transition risk. So anecdotally, if you start thinking what could get wrong, this kind of examples immediately come to mind. So the first example is this idea of the ranking of Europe's climate leaders. This is the FT rankings that tries to give the prominence to the companies that actually tend to be the kind of exemplary in the way how they address the climate risk. But what you immediately see on this kind of list are companies that actually are very responsible for large carbon footprints in total, not necessarily in terms of efficiency, but in terms of actually level of emissions that they produce. So even though their intensities may be actually quite low, I think it is quite stark to see that they still actually contribute a lot to the global carbon footprint. And a little bit on a different front, here are the two examples of companies that I have taken from the data, which kind of show this stark paradox. A company, Fortum, that has reduced its emission intensity of a particular period by roughly 30%, but at the same time increasing its carbon emissions by 157%. So the question is, how can the two be actually reconciled? Of course, the simple answer is if the company is actually growing faster than it's actually growing its emissions, that naturally is going to actually reduce its intensity, even though the total levels of emissions is actually going higher. But more on the academic side and more theoretical side, I actually have worked on this problem and have shown that you can actually prove that for intensity to actually be the sufficient statistic, you need pretty stark actually and restrictive assumptions on your economy. So the first assumption is what I'm going to call proportional scaling. So in a nutshell, what this means is that the firm that is twice as large with twice the emissions has exactly the same kind of twice dollar exposure to the risk. So in other words, everything is kind of scaling in exactly a unit for unit aspect. Of course, this is a pretty strong assumption. The second thing which is required is something that I call the scale invariance, which is intensity should not depend on how large the company actually is. It should be that if this is a sufficient statistic, it doesn't matter what's the size actually of that particular company that you are dealing with. And the kind of consequence of the 1 and 2 is that if I add any other measure that I potentially consider as relevant for transition risk, it should be that these other measures don't enter significantly into my risk model. It should be that intensity essentially captures all the exposure in this particular model of risk or model of expected returns. So these are, of course, questions that you could pose empirically and see what the data tells you. So I want to show you two kind of results. These are very recent results that I have produced in one of my new paper, which kind of take these assumptions and try to formally test them. So the first assumption is the scale invariance. The idea is if I'm going to sort companies with respect to their size into 5 equal size bins, where the first bin are the smallest company and the last bin are the largest companies, I want to see how much intensity affects expected returns in this kind of 5 bins separately. And what I'm showing you here are essentially carbon premia or the intensity premia associated with each individual levels of intensity within each bins. Remember, if intensity is sufficient, this number should be identical. Clearly, when you look at this picture, this is far from being the same. We find that there is quite a lot of heterogeneity across the size bins in the way how intensity actually predicts expected returns. So in this regard, we are directly actually failing to meet that specific condition that is necessary. If you want to take it one step further, you could actually think of the following simplest framework, where you are going to relate future stock returns to measures of intensity, and then you try to see what would happen if you actually add anything else beyond that. This is the idea of spanning. And what you see in this table in column 1 especially is that intensity on its own is actually a positive predictor of risk or expected returns. But then, interestingly, in column 3, once you control for the level of emissions, the importance of this intensity actually disappears. And quite the opposite, actually, the level of emissions becomes positive and significant. So this is kind of the back of the envelope of the calculation of what potentially the regulator would miss if it actually mistakenly attributed the risk to intensity only, rather than to recognize the fact that the spanning condition actually fails. So we see that on an annualized basis, that would be roughly 4.2% difference in expected returns. Clearly, this is not a trivial number we should be thinking of. So the lesson that I want to kind of draw from this simple exercises is that this basically metric clearly does not fit the question of risk management. And more so, even though it actually works well for the planner problem, it need not to work well for the financial markets. So in other words, the right metric depends on the question that you want to actually answer. So general principle I draw from this is that planner or implementation metrics need not to coincide with what we call the pricing metrics. And clearly intensity is not unique in the way how we should think about pricing transition risk in financial markets. So then the second issue I wanted to mention as potentially worth thinking about is this story of portfolio manager. So clearly when we think about transition risk, oftentimes we try to do it from the kind of bottom-up approach, where we try to attribute transition risk to individual names in our portfolio, and then only then we aggregate it into the overall portfolio. From the perspective of the manager, clearly they care about the entire portfolio, not just about individual constituents. So the question is, how does this aggregation work? How do you go from the world in which you actually have individual level intensity metrics to the world in which you actually need to think about this risk at the portfolio level? So the profession has kind of oftentimes resorted to this measure of WACI, or the weighted average carbon intensity, which essentially is the value-weighted kind of approach, depending on how you define these weights could differ, of individual carbon intensities. And whatever that value-weighted number is what ultimately actually underlies your risk management that you should be doing as a portfolio manager. So why is it appealing? Clearly, it's very easy to calculate. Once you have your individual measure of intensity, adding weights is literally no-brainer. It's also widely used. TCFD actually recommends using something like this. And clearly, from the portfolio kind of optimization, we are used to this kind of aggregations. It feels like it's intuitive. This is what we should actually be doing, taking some kind of weighted measure of the individual efficiencies. But I want to argue that maybe this is not as obvious as it may sound, largely because there is an issue of some kind of correlation structure that we need to think about. So let me give you an example. You have two portfolios. In one portfolio, you have 100 firms. Let's assume that all of them roughly have medium level of intensities. And then contrast this with the portfolio B, which has 50 companies with the low intensity and 50 companies with a high intensity. Let's assume that the numbers work out the way that the WACIs for the two portfolios are the same. So in some sense, the medium kind of intensity comes kind of in between the two high and low kind of spectra. So you would think that this is the way in which the two portfolios face exactly the same risk. But clearly, this is a little bit misleading because intuitively, if you think about the climate risk, we recognize that these things are not linear in the way how they scale with this kind of exposures. So in this regard, if you just take a simple kind of linear average across the different names, you are missing some of this kind of non-linearities and the potential correlations that are actually driving the portfolio that you manage of these companies. So what should you be doing instead then? Well, the natural kind of solution is think about the entire distributions rather than averages. So rather than thinking about the metric which just simply takes expectations, you should think about some kind of metrics that aggregates across the entire distribution of intensity that you are facing in your portfolio. You should definitely model nonlinearities. This is what the climate scientists have been telling us for a long time, that nonlinearities in the climate world are very important. So one way to think about this is maybe separating our models into high emitters and say moderate and low emitters, and do this kind of in the clustered kind of framework. You may want to account for the correlations, sectoral, geographic, and think also of some kind of dynamics in which this WACI evolves over time. So then the last thing I wanted to mention as a case study to kind of motivate potential issues is this notion of timing. So when we think about something like emission measures, oftentimes these measures are criticized because they are backward looking. People argue that this is what has already happened, but really risk is about the future. It's not about the past. So in this regard, you may want to actually think about incorporating some kind of forward-looking information. And the profession has tried to embark on this particular answer and try to offer some solutions. So here I have listed a few that are, again, a little bit of a subjective list, but not totally inconsistent with what I have seen practitioners and also academics think about in this context. So you can think as an example about some kind of green revenue shares. You can think about CapEx allocation to green investment. You can think about net zero commitments. And you can also think of some kind of ITR measures, which are these implied temperature rise measures. So what I'm trying to say about each of them is that each of them has some kind of notion of forward-lookingness. But at the same time, what we want to recognize is that they actually come with their own kind of problems. When you think about green revenues, the immediate question is, what defines green? How should we be attributing actually revenue to a green object? How easy it is? I suspect it's not very easy. Some academics have worked with it. I think they found the challenges already themselves. When you think about CapEx allocation, of course, the story of CapEx is the time to build story. It could be that these things are inconsistent with the timing in which you want the investment to work. And on top of that, CapEx by itself is a noisy measure in which we actually think about addressing things on the real kind of side. Commitments. This is a big topic, highly criticized because of the lack of credibility. So there is a lot of variation in the way how commitments are being expressed and how companies actually address them in their own kind of models. And then finally, the ITR, this idea of the temperature of the portfolio or the individual holdings, is also problematic because it's actually highly model dependent. So depending on what you actually put into the model, you may actually have different answers in terms of what these temperatures actually are. So these are the issues that clearly are practically relevant, and we should be thinking about how to address them. So again, a couple of suggestions that come to my mind. We should be thinking about different policy paths. Scenario analysis is very helpful. We should actually combine the backward and forward looking together, try to kind of incorporate both current emissions trajectories and commitment. We should always assess the credibility of the commitments that we actually see, or the CapEx or any kind of revenues that we observe. And on top of that, we should never be complacent with what we actually design. We should update our beliefs about the whole process as we observe the change in the corporate behavior. So what I wanted to add to that is something that actually came out of some of the work that I have done in the recent past, which is this idea of forward-lookingness also can actually be applied in a slightly different way. And in the way how practitioners have tried to embrace this is this idea of a net zero portfolio. So shortly, net zero portfolio is the idea where you are trying to basically emulate the carbon footprint of your portfolio in a dynamic sense relative to the decarbonization paths that we have from the scientists. So scientists tell us how we should be actually decarbonizing the global economy into 2050. You could think of the same kind of curve, the shape of the curve, as being applied to your portfolio. So what does this essentially create? It creates a very interesting economic framework and financial framework in which you can actually use this kind of decarbonization paths on the portfolio as a way to actually predict divestment in the future and also as a way of engaging with companies. So essentially, as the carbon budget becomes smaller and smaller, which is what scientists tell us should be happening, you may see that unless companies decarbonize, fewer and fewer companies would actually fit into this kind of framework. So that creates essentially this idea that there would be an expected divestment from the portfolio. And why is this useful? Clearly, we know that divestment has potentially price effects. But on top of that, because it's not yet happened, you can actually use it as a communication tool. So in a way, you can also express a form of engagement if you are a manager of a particular portfolio. So this is attractive because in some sense, in one framework, you are kind of nesting together two ideas, the idea of divestment and the idea of engagement. Typically in the literature, people think of these two as being two separate kind of forces. So now let me talk a little bit about other bigger picture issues that I think are relevant in thinking about transition risk. So I want to talk about three what I call misconceptions in how I see the profession oftentimes think about the problem. So the first misconception I'm going to call there is a best metric. So what I have seen, including my own work in the past, is that oftentimes people try to pick their favorites. They have a way in which they think we should be thinking to measure a particular type of risk, in this case, transition risk. But as every metric has something real to say, what I want to caution, and this is what I've already signaled with the intensity exercise, that it's very hard to imagine that individual metrics would be sufficient. It's oftentimes important to recognize that each metric is going to depend on objective. I already mentioned to you the planner versus pricing. You could add to that disclosure rules. You could think about horizons. Different metrics may be differently applicable for short-term versus long-term kind of transition. And then you can think about your own kind of use. Some people use it for portfolio construction. Some people use it for stress testing. Some people use it for engagement, as I have just mentioned. So just to give you a few examples, intensity is right for policy, as I've mentioned, not really sufficient for pricing. Levels are useful for impact, not always efficiency. Trajectory matters for short term, not necessary for long term. So the principle I think should guide our work is the idea that we should actually think about multiple metrics and think of a framework, I'm going to call it a dashboard, that actually generates some kind of decision tree on what's relevant for us in the process of addressing the risk that we want to actually hedge or manage. The second misconception I think that I see a little bit in this spectrum is the idea of the data. So many people think that the key kind of problem of the climate solution is the idea that our data is just poorly measured. And I'm sympathetic to the view that data is relevant. But what I want to argue is that actually, even if we had perfect data on scope 1, scope 2, or scope 3 emissions, we would still deal with the issues that I have mentioned, the issue of aggregation, the issue of sufficiency, and the issue of the forward-looking adjustments. So in this regard, I want to refer to the paper I have just posted on SSRN, which essentially takes the scope 1 data, which to many people actually is pretty much well measured and well understood, but still presents this evidence that intensity is not sufficient even in that world. We observe a perfectly precise measure, but using just that measure of intensity is actually not going to be the right way to think about risk. So the principle would be data is valuable, but it does not free us up from actually thinking about the economic judgments of what risk to measure and how to actually address them. And then finally, there is this kind of market-based story, which is people have this kind of view that, look, at some point, markets are going to figure it out and we are going to actually price this risk properly. So let's not worry about it. But what I want to argue is that this kind of ideas of market efficiency oftentimes don't come for free. They come with the assumptions of complete markets, markets that can be actually perfectly hedged. They come with the ideas that investors are somehow homogeneous, this kind of representative investor framework. And they come with the idea that we have full information, which of course is a very strong idea. In reality, as I could argue, none of this hold. And we actually should be skeptical about making assumptions like this. And the upshot of this is that if we actually relax any of these assumptions, this idea of market efficiency is likely going to break. In incomplete markets, in markets that face heterogeneous investors, and there are different basically information sets, we should not expect that actually market is going to figure it out. We need to actually actively manage risk and find best available tools that could actually serve different objectives that we may have. So kind of to finalize in the last 10-15 minutes I have of where I would like it to go, I want to offer a little bit of a personal framework, a practical framework that basically may be helpful for some of you in the audience. So the first thing that I want to start from is this idea that I think inherently what I see is that transition risk is multidimensional. By all means, I think it's a little bit of a fallacy to think that we can actually come up with a single metric that could be applicable to all the cases that we want to address when it comes to transition risk. So in this regard, I think we need to embrace this idea that there is some kind of notion of the multitude of measures that we have to deal with. And then again, as I've stated, that has to be evaluated in a very rigorous way, thinking about what decisions we are making, what's the objective of that, what's the horizon, and what are the kind of scenarios that we are actually worried about when thinking about that, hedging that specific risk. So here is the kind of one attempt in which I would like to map some of these basically metrics to investment decisions. So when we think about something like portfolio construction, clearly to many investors, and I'm sure my co-speaker Sara is going to talk about it with more eloquence, we need to think about models of expected returns, models of risk. Oftentimes we use intensity, we use absolute emissions, we use emission trajectories as basically relevant metrics to inform that. Clearly, when we talk about portfolios, oftentimes we are talking about short to medium term. So these portfolios need to be rebalanced. So we need to kind of gather this information with some kind of quarterly, sometimes even higher frequency, depending on the application. But you can then contrast this with something like stress testing. Stress testing is a very different exercise. We want to think about the tail risk in stress testing. We want to think about extreme scenarios. We want to think about stranded asset problems. We want to think about policy discontinuities. And of course, many of these things need not to happen immediately. So horizon changes, and as a result, also our updates frequency change as well. Then we have engagement. And again, a different set of objectives and different set of measures could be used, as I have, for example, highlighted with the net zero framework that can be used as a form of engagement. And then finally, we have disclosure, which comes again with some kind of regulatory framework and also various metrics that are associated with this particular concept. So then we may want to think of some kind of dashboard approach. How should you stratify actually your approach to carbon transition risk? So again, a little bit subjective, but I kind of try to prioritize some of these frameworks into what I call tier 1, tier 2, tier 3, and tier 4 concepts. In my opinion, tier 1 is what I call the core metrics. These are the metrics that always should be tracked, and those involve basically emission kind of relevant objects such as levels, changes or intensities, but also sectoral exposures, etc. You do portfolio monitoring, reporting based on this kind of measures. Then you have risk metrics. These are important to think about the kind of whole spectrum of risk that we find. This can also include something like tail risk, in which case, as I mentioned earlier, we may want to broaden our spectrum of metrics. Then we have all these forward-looking metrics that allow us to think about the strategy to transition, the credibility, and together with engagement and some kind of scenario analysis. And finally, of course, depending on the particular context in which you live, you may live in the country which or the region which has ETS, others who do not have ETS. So you need to tailor kind of your exposures with respect to some kind of local framework that actually guides this particular region. So when you think about implementation, again, some things are easier, some things are more difficult. Again, I kind of put here 3 phases you may want to consider. In the short term, you may want to just simply augment your existing approach by at least recognizing this idea that there are actually multiple objects that should be taken into consideration. A good test for that, and I'm sure that Sara is going to touch on that, is some kind of back test to what extent our risk predictions are actually improving if we allow for these other metrics to actually inform our risk management model. Then after that, of course, you may want to actually have an edge. So you may want to build your own proprietary model that is going to kind of rely on some specific metrics that you find are important. You may want to invoke your particular way of thinking about nonlinearity, scenario analysis. And then, of course, on top of that, we have the dynamics that we have to deal with as the policy and other aspects of the transition risk change. And then together, I think what's useful to understand is that there should also be an open communication channel. And that should be continuous in a way that whatever you do on your risk management would be useful to actually combine together with a form of engagement. As I already highlighted, this idea of forward-looking measures is kind of a potential promise in this regard, but you could also engage even using the backward-looking measure in a very kind of related way. So kind of to summarize in the next few moments, let me kind of offer to you how I see the world essentially changing or not changing. So what I have seen over the last couple of years, maybe a decade at this point, is that clearly the whole idea of what has come out of Paris and maybe earlier COPs is that we have actually recognized better data. The data is still not perfect, especially when it comes to scope 3, but it's actually fair to say that what we observe actually is the much better data than we started with. These days, we talk about satellites, we talk about supply chain kind of mapping that is much more precise than what we used to learn about 10, 20 years ago. There is clearly more policy clarity, at least in some frameworks. Paris Agreement was very useful. It put certain objects on board. It created the framework of commitments and came up from science with specific recommendations of what should be our decarbonization pathways. We have carbon pricing, as I mentioned, not perfect, but at least it's present in certain jurisdictions. And clearly one of these big kind of benefits that we have witnessed over the last decade is the falling cost of technology of renewables. Solar, batteries, hydrogen, wind, all of these are basically more accessible than they were a decade or 2 decades ago. And finally, because so many people are thinking about it, they are trying to make this work. Clearly, we have better models. There is a lot of stress testing kind of framework, and GFS is one of the leaders, but not the only one. We have, of course, a lot of kind of integration between physical and transition risk. And these days, we can also benefit from all this machine learning technology to learn a little bit more about forward-looking predictions. So it seems like the world is kind of great, it's sunny and everything is perfect, but I want to a little bit caution on that because there are certain things that actually are not changing. And I think it's important because they kind of underlie the challenges that we need to tackle. So clearly there is still uncertainty about policy. I don't need to go into details, but observing what's happening in the world right now clearly tells us it's far from the certain world in the way how climate is being addressed on various spectrums. There is a huge polarization about this issue as well. People carry heterogeneous beliefs, and the moment we go into this heterogeneous, that opens up the issue of pricing in a very different scale. It leads, among others, to this story of incompleteness. Hedging becomes much more difficult if you don't have perfect instruments to actually hedge that risk. So you need to kind of start building models that no longer actually involve one metric, such as the planner problem, but they actually involve multiple metrics, and you need to start judging how to actually weight each of these metrics in your risk management solution. And that, of course, requires a lot of subjectivity. We need to actually use judgment And no amount of data is going to help us with this because that actually involves economic thinking. So what I strongly believe is that that judgment should not be a pure statistical process. It should be actually a process that kind of starts from first principles, where we actually ask questions of what are the risks that actually matter for our portfolio. How is it that we think about the importance of these risks in the context of our portfolio? What are the scenarios that are critical to how we actually think about the wealth that we are trying to actually manage? And finally, are these actually objectives consistent with everything else that we are doing? The story of fiduciary duty as a potential counterforce into some of these sustainable initiatives is clearly oftentimes mentioned in the practice, but also among policymakers as well. So let me conclude by saying that transition risk is clearly a very important object. It is one of these risks that is relatively new from the perspective of how we formally discuss it, but it's clearly not irrelevant. I think it's relevant because the issue of climate is actually real, as scientists tell us. And turns out that thinking about transition risk, even though conceptually is fairly palpable, is not always easy. We actually need to have frameworks in which actually we generate what are the right exposures and what are the kind of right weights that we should apply to all of these exposures when we actually measure that risk. And again, I don't think we should strive for perfection. I think what is more actually practical is to have a consistent framework. The framework that actually follows some of these principles that I tried to outline, and maybe some others that I have not actually thought about, or maybe I didn't have time to talk about in detail. But just to finish with a little bit of a half full glass, I think we have made a lot of progress in the last 5-10 years. I think we understand better where the risks are coming from. We have access to more data. We have more evidence, empirical evidence telling us that these things matter. And now what we need is more discipline. We need to actually preserve some kind of structure and economic thinking in the way how we address it. Thank you so much. And I look forward to Sara's discussion and additional questions.
Well, thank you so much, Professor Marcin, for your very insightful talk. You see already there are claps from the Zoom webinar. So I definitely find it very helpful as a researcher myself. It actually gave me some new ideas about measurements of especially the wacky concepts. Quite interesting. So I'm sure that this concept and a lot of things that you have talked about are quite relevant for the practice as well. So I guess this is a very good time to move into our discussion and Q&A. So our discussant and moderator today is Sara Rosner. She is the Director of Responsible Investing Research and also Senior Vice President at AllianceBernstein, or AB. Sara's work is actually at the very sharp end of today's topic. She's responsible for implementing AB's approach to managing material risks and opportunities from climate transition, as we have been actually hearing from Professor Marcin today. And what makes Sara particularly suited for today's dialogue is her deep connection to both sides of the aisle. So she collaborates closely with the Columbia Climate School to integrate climate change considerations into the investment process, while also leveraging a rich background in journalism and industry research. Sara is recognized as one of the Crain's New York business notable leaders in sustainability. Is a very long name. And she's an active member of both 100 Women in Finance and Women Investing in Sustainable Economy. So we are very eager to hear how she connects Marcin's academic insights with her thoughts and questions from the field. Now, Sara, I'll pass the mic to you.
Thank you very much, Yuxia. My name, and for the introduction, Marcin, for your very timely and insightful remarks. Before I get started, I would just like to remind the audience that I will be monitoring the Q&A box for your questions. I see a number of questions have already come in, so please add those in and I will try to address those with Marcin when the remaining time that we have together. So as Yuxia noted, I work for AllianceBernstein. We're a US-based asset manager, and we view climate change through the lens of financial materiality and how this can affect the performance of the capital that we manage on behalf of a huge range of clients. We manage over $800 billion in assets for institutional, retail, and private clients. And they bring a huge amount of interests, variability in those interests in terms of how we manage that capital. What I really enjoyed about this platform that has been created is that we're bringing together academic practitioners and financial markets participants. And that's very emblematic of the approach that we've taken to addressing the issue of climate change at AllianceBernstein. As Yuxia mentioned, we embarked on a collaboration with the Columbia Climate School in 2019. And we did that because we recognize that there is not one single organization or sphere that's going to solve for the issue of climate change globally. And so we really needed to, as an organization, think about outside the box in terms of the resources and the experts and the partners that we are going to need today and into the future in order to make better decisions on behalf of our clients. In 2019, we really focused, and the heart of our partnership with the Columbia Climate School has really been on bridging that gap between science and investing and using empirical evidence to help our investment teams make better decisions on behalf of our clients. We've learned a lot from these experts. We recently executed our third Climate Science and Investment Academy, which brought together hundreds of market participants globally, as well as AB investors and Columbia faculty and scientists to discuss a range of issues from the advent of AI, water, geopolitical issues, et cetera, which is really showed an evolution in terms of how we've thought about these issues since we first started our collaboration, when we were very focused on the basics of climate science. Once I think we had really addressed, I think, a lot of the knowledge gaps, we embarked on developing something called our Climate Transition Alignment Framework at AllianceBernstein. The purpose of this strategy is to identify the material transition risks and opportunities within our actively managed equities and fixed income portfolios. And again, the emphasis there is on materiality, so thinking about financial materiality. We use a variety of data sources to, and the process goes like this. We use a variety of data sources to identify which companies, portfolio companies, out of those thousands and thousands and thousands of companies that we cover are really at the most material risk in terms of the transition to the lower carbon economy, or really potentially at the intersection in terms of unveiling the most opportunity. And often companies that are at the most risk also have the most opportunity. There is no transition to a lower carbon economy without some of the heaviest emitters in our portfolio pursuing these opportunities in their respective markets. Once we've identified those issuers, and there's generally less than a handful in each portfolio that we cover, we are able to run an assessment that looks at things like emissions metrics, that we are also looking at things like commitments and targets. And we're also considering, as Marcin mentions, more forward-looking metrics such as CapEx, OpEx, trying to understand how a company is investing in products and services that will make them competitive or remain competitive in the global energy transition. And once we do that analysis, we kind of step back with our investment teams and we try to understand, okay, where is this company falling short somewhere? And if so, where? And how do we engage with these companies over time in order to help them improve their performance, help them improve their long-term viability in a lower carbon economy? So with that in mind, I think, Marcin, you kind of made a remark about what's happened in the past 5 years and what's improved, maybe what's, what are we less optimistic about? And one of the things that I considered was, okay, what has happened in the past 5 years? What are the things that we didn't think about, or we didn't maybe forecast? And there's a couple of forces that come to mind. So number one is obviously deglobalization. So thinking about the level and volume of geopolitical issues that we're seeing around the world and how that can affect the energy transition. Clearly, we've mentioned this a couple of times, but artificial intelligence, I don't think you can have a discussion about climate change today without thinking about this issue. In the US alone, the Department of Energy estimates that we are looking at more than 580 terawatt hours of energy demand from data center development by 2028 at the high end of the spectrum. That's equivalent to almost the entire energy consumption of the United Kingdom in 2023. We're also thinking about physical risk more than we ever have before, right? So in 2024, Bloomberg estimated that there was costs of $1.4 trillion related to natural disasters alone. And we are seeing record payouts from insurance companies in order to compensate for these events, as well as record numbers of billion-dollar plus disasters occurring around the world. And so the last item that I would just want to put in terms of what we're seeing versus what we're not seeing, and I think, Marcin, you touch on this in a number of ways in your presentation, is I think a lot of the commitments and the targets that were set maybe 5 years ago were really depending on a high degree of policy support and incentives that perhaps were not really realized over the time over that 5-year time frame. So today there are just about 80 different countries or jurisdictions that have some degree of active carbon tax or emissions trading scheme or pricing. And yet we're still not seeing, I think, a significant move in terms of incentivizing more investment in products and services that will generate green revenue, et cetera. So with that in mind, I'm going to kick off and get into some questions here. But again, just want to encourage everyone to continue to ask questions in the chat. And I see a number of them. I'm going to start at a very broad point here, but Marcin, you really focus on transition risk. Is the intention of your work to lower what we would call in the investment management setting real world emissions or not? And if so, how does it apply? If not, why not?
Mm-hmm. Yes, no, thank you so much, Sara. I very much enjoyed your general remarks. I fully agree. Some of these issues I clearly did not emphasize as much, even though I do agree with you that they are extremely important. Deglobalization, AI, physical risks, commitments, all of them extremely important. Each of them could be a separate 1-hour talk. So yeah, I fully agree with you on that. In terms of transition risk, that's actually a good question. What is really the end game in a way, in the way how we are actually thinking of that? To be honest with you, my original kind of work that I've done on this was exactly informed by that. I started thinking about transition risk by essentially thinking about the net zero as a kind of objective, which is we need to do something that potentially gets us from where we are right now to where we are going to be in the future. Of course, I want to be very open that my thinking has also evolved over time. I learned a lot from a lot of research I've done and also listening and reading about what other people have been talking about. I think I would still probably stand, Sara, by the view that the end game matters. And I think it is that the decarbonization that we are talking about. But I also agree with you that it cannot be done without thinking about some of the constraints. And you have mentioned some of this, including the materiality. I would say there is also some kind of notion of how we should be thinking of the sectoral composition. What does it actually imply for other objectives that we may have, not necessarily financial objectives? There are all these UN kind of principles that we are encouraged to follow. What's interesting about that is sometimes these principles are not necessarily consistent with each other when it comes to climate versus something else. But But look, I think transition risk exists as long as we think actually we want to do something about the problem. If the world ignores the problem and says, look, climate is not an issue, we don't need to decarbonize, I think naturally one would say that decarbonization or the transition risk is less relevant. It's only in the way that we actually want to make the change in which that transition risk becomes relevant. And maybe to kind of summarize and let other questions be asked, I just want to say that the way I see it, it is as important for an obvious reason. It's just a risk that needs to be managed. So even if we ignore any other kind of non-financial aspects, non-kind of risk-based aspects, I think the story is just a simple risk management story that has to be taken on board.
And that brings me to another question. Again, I just want to say thank you to the audience for adding in so many questions here. I think there's been a lot of overlap with what I plan to discuss, so I'm going to try and address as much as I can. You mentioned some of the policy and the scenarios that should be considered. I think there's a large contingent of folks who are wondering today, should transition frameworks really be considering a target of net zero by 2050 if the global carbon budget for both 1.5 and well below 2 degrees will likely be exhausted before then. What are the assumptions that we should have in the scenarios that we're looking at? Do you have a view on that in terms of policy and other inputs? And I would like to thank James Hewitt for his question here on that today.
Yeah, I think this is a fantastic question. And I think I will not be delusional in a way that I do agree that the chance with which we are going to kind of align with the 1.5 degree objective is very slim. So we are missing likely on that specific target. So the question is, what does it imply for everything that we have kind of built around? So I have kind of two thoughts. Of course, on the quantitative side, maybe we do need to kind of adjust our models and think about basically the climate science from the perspective where we are right now. So we should not pretend that we have actually failed in this particular process. But on a slightly different note, and I think this is what I think is a healthy way, I think even though the chance that we are going to actually meet this, some of these tight targets is pretty slim, I think it may be still useful to actually maintain them, because I think this idea of ambition is very important, at least as I see it in this solution. I think if we kind of settle on, again, we have some more loose and lax constraint, that may actually slow us down in the way how at least some people have tried to address this issue. So I would prefer that we fail by trying hard rather than we basically adjust the problem and make it easy on our side, or at least easier, let's put it this way.
And what sources or models do you recommend, or scenarios do you recommend for building these dashboards? I know you mentioned NGFS. Yes. As a leader, but are there others that you think are particularly robust?
Clearly NGFS has been one of the kind of key frameworks. It's not the only framework. So there has been a framework that Bank of England at some point was actually trying to build. I know that ECB has been also independently thinking of some scenarios. Generally, I also think IPCC and all the initiatives around that are a good kind of source of information to think about what the different scenarios we should be taking into consideration. I definitely think what's important, Sara, is that the scenarios need to kind of bridge the science with the economics. We cannot just simply think about scenarios from the perspective of growth, but at the same time, we can also not only think about scenarios from the perspective of science, the physical science. So I think to me, the most promising kind of approaches would be the one that try to kind of blend the two together, because ultimately this story, what matters is only growth and nothing else. I find it's a little bit naive if the world looks very different than it does now. I mean, all these notions of growth are going to become second order if the quality of just livelihood that we have from the pure principle of how hot the planet is going to become problematic.
And I'd like to just talk, you mentioned the physical observation, and we do have a question here from Michael Yin, I also prepared a question around this in terms of how does the advent of increasing physical risk affect your thesis or your view in terms of implications for metrics, emissions, technological solutions, or setbacks? Will physical risks, in your view, ever reach a critical mass in terms of incentivizing greater and more consistent consideration of climate risk in the investment process?
Well, this is fantastic. And I would be very honest with you, Sarah. When I started thinking about this problem more than a decade ago, I somehow started from the view that physical risk was kind of independent of transition risk, in a sense that I was holding this view that, look, transition risk is going to happen independent of what happens in the atmosphere if basically the policymakers or the technology goes in that direction of decarbonization. So one could argue it doesn't matter. But I think, like I said before, my views have evolved a little bit on that. And some of the work I've done recently also are kind of in that spirit. So just to give you two answers, maybe just briefly. The first answer I want to give you is that if you think of a really serious kind of economic framework on how to build this kind of multidimensional problem that I have actually signaled in my talk today, I think one of the key inputs into the model like this, Sarah, are climate damages. So climate damages are relevant for how we should be actually thinking about pricing risk, which kind of sounds intuitive, but I just want to reassure everyone that this is actually part of the economic solution that has to be basic or economic concept that we need to think about. So from that perspective, damages clearly are a function of physical risk. And we need to think about that as being informative of this particular damage aspect. So that's kind of more kind of first order economic mechanism that I think gives you that intersection between physical risk and the transition risk. But a little bit more maybe philosophical or more on the belief side. I strongly believe that the whole kind of world of polarization where we observe right now skeptics, how climate is going to change, may largely turn around based on physical risk experiences. I mean, we have observed, you live in the United States right now, but it's not just US only. It's all over the world. The frequency with which we are observing some kind of climate-related events these days, it's enormous. It's essentially an order of magnitude of what the business as usual would have predicted. And what I'm trying to say with that is that the very skeptics who are now expressing doubts about the climate may be the very first one to demand actually something to be done if their actually comfort of living, if their ability to actually prosper is going to be threatened by these physical risks. So I think that actually that physical risk, paradoxically and kind of sadly, can be what will give the turnaround into some of the policies. It's like it will become inevitable that something has to be done. And at this point, the society is going to demand it. And I just give you one example. Again, it comes actually from my conversation with people in China. I used to go to China to teach there, and I remember the kind of passage of kind of experiences. The first time I went to China, everyone kind of talked about economic growth. Everyone was fascinated how China was moving fast, how everything was being developed. And this was really amazing. But then 5 years or a couple of years later, I went to China and I noticed something very interesting, which kind of I hope will make the point clear. That out of a sudden, that conversation has slightly shifted. People said, look, I like that economic growth, but I also want to breathe clean air and have clean water in my tap. So out of a sudden, the very same people who were amazed about actually the economic growth that China produced were the very skeptics, is this within the right boundaries? And they demanded the change. And we know, going to China these days, we see how much progress has been made, for example, on the clean air. I mean, Beijing is a clear example of that. It used to be a very kind of polluted city, is much cleaner than it used to be. So what I'm trying to say, I don't think this is just a story of China. I think it's the story that we may actually witness in many locations. That people basically at some point will reach this kind of inflection point, or as you said, tipping point on their own personal side, where they will actually demand change. Rather, this will not be like anymore up to the politicians to decide it. There will be a big movement not because people will think, oh, I care about climate. They will just say, look, I just suffer one way or another. You need to do something about it.
You bring up an interesting question. I think a lot of folks are grappling with in the wake of recent developments, or maybe even not so recent. But what, in your view, does the energy transition look like if China is emerging as the leader of that transition? And do you believe that?
Yeah, it's a fantastic question. I mean, clearly, this is highly related to your first comment about deglobalization, but I would say it's a very geopolitically minded question in a way that, of course, it carries together the kind of economic value associated with that. So there is a notion of many dimensions. One being, is China going to take over everyone and we are going to become dependent on one particular country to actually come up with these solutions, which of course could be potentially a threat, because if someone controls a particular resource, that may be actually quite risky for the rest. But at the same time, what is also kind of like a flip story to that is the story of costs. It goes without saying that things like solar, especially, have actually managed to go down in terms of the cost, largely because of what has happened there. So in this regard, I would say China has been instrumental in the way how it has actually allowed for the access to technology to actually, at the cheap cost, to actually take place. So I think we should embrace that as a kind of good. But of course, at the same time, as anything in economics, we also need to think about potential risks and constraints that this can carry. But I think it is a solution, Sara. I only want to mention something that you mentioned in passing, and I fully agree. And this kind of touches on that issue of AI. I strongly agree with everything you said. As you know, I have a work on that as well right now. That story of growing AI is not an unconstrained story. And the story of limited resources, and here electricity, water, etc., are the examples, is critical. And I think we need to be aware of the fact that in that particular story, the renewables are going to be struggling to be 100% energy source, largely because at the moment we still have this problem with intermittency. The story of storage and transmission of energy across regions, it's a real story. So in this regard, we need to have some instruments to hedge that. Not hedge it in a financial sense, but to actually have some kind of fallbacks. And I'm not saying we should keep coal, continuing at the rate it used to, but I think there has to be a little bit of a kind of backup in the case in which we cannot actually sustain this kind of energy demands that you talk about. And it is stunning. I fully agree with you. The excess capacity that people forecast in different countries and US especially is scary low. We are going to struggle with free electricity, and this is going to cause a lot of disruption in companies, not just those which are AI impacted. Keep in mind that electricity is a global kind of service. So to the extent that the AI sector is going to soak up some of this, suck in, someone else who is not necessarily AI is going to suffer as long as they depend on that energy as well. So this is like a little bit like a global village where we are all kind of connected together. So I think this solution of how is it that we should create this energy mix, and that's touching base on your original question about China, is very relevant. We need to be a little bit careful on how this energy mix actually solutions are going to be structured, at least in the short and intermediate term. Once we find maybe more sustainable solutions with storage, batteries, etc., maybe that will become less of a concern. But at the moment, I think that's exactly what I would call is the transition. We need to transition. We cannot just literally flip the table and just say now everything is renewable overnight.
Thank you, Marcin. And so I think in regards to some of the remarks that you've made touching on certain industries and sectors, we have a question from Enrico Bernardini, who asks, how would you see a way? So first, he kind of sets up the question. The concept of high emitter concentration is very important and often overlooked. How would you see a way to address it, either across sectors or within sectors? How to combine diversification with carbonization goals?
Just to be clear, when we talk about diversification, we are talking about diversification of economic activity or energy sources. Just maybe I missed the beginning of the comment.
I can infer, but maybe he's talking about portfolio management in terms of diversification.
Okay. Yeah, no, so
And Rico,
absolutely.
sorry if apologies if I'm not interpreting that correctly, but I'm going to go with that vein for this.
Let me just offer maybe my broader perspective in a sense that we can, irrespective, I think both questions are interesting. I think from the portfolio perspective, of course, I think this kind of approach that I see the most promising, at least at the moment, is what I call this industry neutrality story. I'm sure, Sara, you see it on your desk as well when you manage some of this risk at Allianz, that basically we don't want to kind of structure portfolios that ignore big chunks of the sectoral representation. And if you wanted to kind of take unconditional view to that, this is what would likely happen. You would exclude some of the sectors right away just because they generically are more exposed to this problem than others. So in this regard, I think it's useful to think of some kind of neutrality or at least some parity that you want to apply in the way how you structure your portfolio. On a broader level, when it comes to economic diversification, I actually think that the Middle East is a very interesting example of that. And again, it's a very ad hoc thought I want to give to everyone, but this is something I actually thought about a little bit. If you think about what has happened in Middle East, it's a little bit of an interesting story, which is, of course, not a surprise to anyone. Middle East kind of benefited hugely from the oil as the resource. But when you see what's happening right now in the Middle East, you kind of see this diversification taking place. Essentially, a lot of these countries, and I'm sure many of you would have agreed, have kind of created a parallel world in addition. Saudi Arabia, Emirates, Qatar, etc., are building basically streams of economic activity which are almost like hedges of this oil kind of exposure. So they are aware of the fact that at some point maybe this oil will be the stranded asset, and we are going to be talking about basically phasing out some of these activities sooner or later. And they are kind of getting ready for that. And I think this is partly what I think, Sara, I was talking to one of my colleagues today, what I think drives a little bit of a geopolitics right now. I think different countries globally, and again, I don't want to make it a political statement, are kind of making different bets on what is that kind of transition stage that we are going to. And again, given what's happening in different parts of the world, you can fill in the blanks. I hope you agree that different countries kind of protect different status quo when it comes to what this basically sectoral representation in the future should look like. Just as an example, of course, United States, at the moment at least, highly protective of the oil industry. So in this regard, clearly it is taking some bet that oil is going to become relevant. But you could take Europe on the other side, at least until recently, where exactly the opposite was happening. Germany at some point had this Energiewende policy where they kind of moved away from nuclear. Then they tried to promote renewables. This is now a little bit backfiring on the economic front. So there is a lot of kind of strategic positioning, I think, that we are observing. And of course, the story you brought up earlier on China is a classic story of that as well. They made a huge bet on some of these technologies as well. And I think they also have some kind of territory that they probably want to protect. How this is going to resolve exposed, I don't know. And I only hope that this is going to resolve in a peaceful way rather than in a violent way. Because the history has taught me that many conflicts oftentimes lead to the unrest. And I really hope that we can actually prevent that. But I do think that these are seminal moments right now. And I think we need to watch what's happening. And I think our discussion today, I think it's very important in thinking about the geopolitics of what's happening right now in the world.
I'm going to acknowledge that we have about 2 minutes left. So I'm going to tackle, I think, one of the broader questions that's come through and try and end on that. We have a question from Aloke Majumdar. Is carbon transition risk fundamentally a pricing problem, a governance problem, or a political economy problem? And why does that distinction matter?
No, it's a fantastic question. I mean, I partly already expressed my view. I think the simplest way I see carbon transition risk is actually that this is a risk management problem. This is actually not my invention per se. This is Bob Litterman, who many of you I'm sure are familiar with. He said it many years ago that this is how he sees it. But I want to qualify it that I think it is not just a pure risk management problem in a way that it actually gets informed by the other aspects that you have mentioned. The governance, the political environment, unfortunately or fortunately, are actually important modifiers of something that drives that risk management. So in the end, the question is, how is it that we actually structure that risk management, embedding some of these elements that actually are mentioned? And to some extent, the framework I offered today, and I encourage especially those who are more interested in formality, the paper I posted just recently on SSRN is trying to give you that flexibility. You yourself, as the basically producer of your favorite transition risk metric, can actually feed in what you consider to be the relevant kind of dimension of that problem. And then you can work out what it implies about the measure that I actually should be using as a way to manage that particular risk. And in the end, I think financial markets are great in the way how they aggregate these views, and we can see what this actually brings in by observing the prices of assets.
Marcin, thank you so much for your remarks, and also to our audience, thank you so much for these wonderfully insightful questions. Very, very thoughtful. I'm going to pass this back to our host to close.
Thank you so much, Sara, and everyone.
Well, thank you so much, Professor Marcin and Sara, for this very, I would say, quite enlightening talk. And actually, as a Chinese, I've been thinking about the issue when you're talking about the geopolitical risk. Yeah, there are a lot of things. We're just standing in this very exciting moment. There are a lot of things to think about. So, before we conclude today's session, let me just, while you're still here, I would like to welcome you and invite you all to join our next lecture to continue this conversation on February the 10th at the same time. And we will be welcoming Professor Johannes Strobel, apologies for my very poor German pronunciation, from NYU Stern, and with the moderation by Tessa Younger from CCLA. And you can scan the QR code on the screen right now to register and stay updated on this series. So this will bring our session today to a close. My sincere thanks to Professor Marcin and Sara for such a very engaging discussion. We have actually addressed quite some very interesting questions from the audience. And then I would really like to thank the audience for your engagement and the exciting questions and very thoughtful question you posted. And to our organizing committee behind for your very dedicated work to make this collaboration possible and smooth. So finally, please take a moment to fill out our feedback survey when it pops up on the Zoom, and your input will be invaluable for us. Thank you so much for being here today, and we look forward to seeing you again next month. Thank you very much, everyone.